Inflation is rising, the job market is weakening, and fear is once again spreading across the markets. The Nasdaq dropped over 2% in just one day, and Bitcoin dipped all the way down to 111.8. So, is Bitcoin in trouble? Is a deeper correction coming? In today's video, I'm going to break everything down, macro data, market psychology, and price action, and deliver a sharp, focused analysis that cuts right to the core of what truly matters. If you don't stick around till the end of the video, you might miss the point. So stay locked in and make sure to watch this one until the very end. What's good, y'all? It's your guy JC. So let's start with a quick recap of my last video. At the time I posted that, Bitcoin was hovering around 118, and I said I remained bullish long term, but short term whipsaws were still possible. And if that whipsaw happened, I said the buy zone would start at 114k, and if 111k broke, I'd cut the trade. So yeah, I started buying from 114, and my current average entry is 113k. My stop loss is slightly below 111 at around 110.4. Now, why did I place the stop right at 111 and instead chose 110.4k? There's two reasons. First, the top of the demand zone sits right around 110.4, and if that level breaks, we can't rule out a deeper drop toward the bottom of the zone. Second, if you draw the Fibonacci retracement from the 98k low to the 123k high, the 0.382 level at 113.6k has already broken. The next key level is the 0.5 retracement, which lands at 110.7. So, if the pullback extends that far, 110.4 still makes sense as a smart cutoff. Even if I cut at 110.4 with an entry at 110.3, the loss is just 2.3%. If you can't handle that, you should not be trading. My trade plan is always in place, but this is derivatives trading. Being responsive is just as important. So if anything changes, I'll either drop a quick update video or post a YouTube community tab to keep everyone informed. Now let's move into the current Bitcoin market outlook. And here's my view straight up. I'm still bullish. And let me break down why based on macro, psychology, and chart structure. And also explain what I'll do if I'm wrong. Okay, let's talk macro first. The recent PCE inflation data and job numbers out of the US came in weak, and the market freaked the hell out. A weakening job market could lead to a slowing economy, and that pushes the Fed toward rate cuts. In fact, according to the CME FedWatch tool, there's now 80% chance of a rate cut next month. And that's actually a big win for assets like Bitcoin, because unlike stocks, Bitcoin doesn't depend on corporate earnings. The stocks need earnings growth to sustain rallies, but inflation, tariffs, and macro headwinds can crush that. But Bitcoin and gold, on the other hand, are commodities. Commodities, they don't care about earnings. There's no such thing as earnings. Their prices are driven purely by supply and demand. And the biggest driver of the demand is global liquidity. And global liquidity expands fastest when interest rate falls globally. And even before the US cuts rates, the rest of the world has already been easing. So global M2 metrics have been climbing steadily. And if the US joins in and starts pumping money too, the demand for global assets like Bitcoin will grow. And that's one of the biggest reasons I'm still bullish. But of course, if inflation keeps rising, job data keeps worsening, and we get more global headwinds like war, tariffs, we might see more short-term downside first. But that's exactly why I manage risk with a 110.4k stop loss. Now let's dive into the chart. First, we're seeing signs of a potential fake out move in the current descending channel. And if you've been watching my videos, you're probably familiar with this kind of channel setup. So when price fails to break out of the upper channel boundary and makes two swings before breaking slightly below the lower boundary, this is a classic fake out pattern. And as long as price returns into the channel after the fake out and confirms, there's a high chance it would push towards the top of the channel. Now second, let's talk about the recent 111.8K low. That low aligns perfectly with the previous resistance area from earlier consolidation, textbook retest. And same thing happened at 74K low this April and 49K low last year as well, a retest of the previous top. And if you draw a trend line from the 74K low formed during the tariff panic in April to the 98K low during the US-Iran tension, it lands exactly at this 111.8K level. And interestingly, on Ethereum's chart, it also aligns with the trend line stretching from the $2,100 low. And these confluences are worth paying attention to. Now let's talk about the psychology of the market makers and the big hands. So if you've been around since the 2021 bull run, you'll know this already. The game has quite changed. I mean, I started trading seriously in 2023, so I wasn't fully dialed in at the time. But one thing I remember clearly, that the price action back then was very different from how it moves now. Back then, it was Chinese capital that drove the market, and now it's US institutions behind the wheel. The biggest difference is the weight behind their orders. Here's what it means. So in the past, with Chinese money running the show, price would often go further than expected. So support zones would get deep spikes, long wicks that jabbed beyond expected levels before climbing back up. But now in this cycle, it's the opposite. We're seeing more undershoots. Price starts to bounce before hitting the classic support levels. Why? Pretty simple, because now there's ETF inflows, corporate buys, and institutional support below price. And this is exactly why I always track spot ETF inflows. And same goes the other way. In markets that feel like they're about to explode higher, we often see undershoots and price falls short of the everyone's expected levels before pulling back. And of course, it's not always the case. Sometimes it does hit those levels or overshoots. But the broader pattern in this cycle is clear. We've seen a lot more not quite than go beyond. Now, keeping all of that in mind, I'm leaning towards the green box holding. In other words, I expect an undershoot and price to curl back up without breaking below that zone. And now let's go deeper into the psychology behind this chart. So after Bitcoin hit 123K high, it corrected down to 115K. It's a classic retail shakeout. Then came 2 full weeks of boring sideways chop, and that too was a shakeout. Most retail traders using high leverage likely placed their stop losses just below recent lows. And during this consolidation for 2 weeks, price kept making slightly lower lows. Not quite enough to cause a breakdown, but just enough to trigger those stops. So a ton of retail traders likely got flushed out right there. And then price started bouncing back up, baiting retail into thinking the bottom was in here, tempting in long positions. And right after that, bang, a straight drop to 111.8. So if you stop and think about how many retail traders got liquidated or stopped out in that sequence, that alone says a lot. So here's the bottom line for today. I started buying from 114K, and my average entry is 113, and my stop loss is at 110.4K. My view hasn't changed. And 2, macro view. Inflation and job data are weak, but a rate cut in September looks almost guaranteed, so liquidity is not a concern. And 3, if price re-enters the daily downtrend channel and confirms, there's enough reason to expect a push to the top. And 4, cycle behavior, early bounces, not textbook drops. So in this cycle, price often bounces early before reaching the classic support levels That's why I expect a bounce before 110.4, and if that fails, deeper downside becomes more likely and I'll adjust accordingly. And 5, most longs got flushed out. 2 weeks of boring sideways chop and current dip to 111.8. I believe a lot of retail traders with long positions got flushed out, and it's time to flush out those shorts now. So if this video was helpful, subscribing, liking, and turning on that notifications is your way of returning the favor, and see you in the next one.